Hello, and welcome to the How to Exit podcast, where we introduce you to a world of small to medium business acquisitions and mergers. We interview business owners, industry leaders, authors, mentors, and other influencers with the sole intent to share with you what it looks like to buy or sell a business. Let's get rolling. And now a moment for our sponsors. I want to highly recommend you get Acquisition Aficionado magazine. Every month, Acquisition Aficionado magazine brings you tactics for business buying and selling you won't find anywhere else. Learn firsthand from industry leaders who share their success stories, featuring in-depth interviews and stories from leading figures in the business acquisition industry. This multi-platform mobile magazine speaks to acquisition entrepreneurs wherever they are in the journey. And I want you to visit acquisitionaficionado.com today. Hello and welcome to the How to Exit podcast. Today I'm here with Steve Rooms. He is a serial entrepreneurial, financial expert, multi-times CFO. Really looking forward to having this conversation with you today. I know you do a lot of work on valuations and looking at and analyzing the financial health of companies for people. And it's a very critical step in the process. So thank you for being here today.
Thanks for inviting me on, Ron. It's good to see you.
Awesome. Well, we always start off with the origin story. Kind of, how did you end up on a show about mergers and acquisitions?
Well, mergers and acquisitions during corporate life, I'd got involved. I was part of an M&A team. And that allowed me to travel around Europe. So I was lucky enough to go across to France and spend time in Germany and Sweden, and even a little bit of time in Morocco. But I was a small part of the M&A team. And it kind of, once I actually set up my own company, I moved away from that for a while until we got to COVID. And during COVID, the consulting work that we were doing, that stopped. We're still doing the accounting services, providing those services. But I took that opportunity to go and find somebody who could teach me M&A properly so I could do it correctly, because it was always something that really interested me. And that's how I sort of went from having an initial exposure to it to getting more and more involved. So I took 2 courses. One guy is an English guy now over in the US. And also we another more detailed course, finished that in July 2020 and bought my first company in September 2020. It took me about 6 weeks, but I was very lucky. That's not normal.
So you did the 2 courses, but you came from a background. You came from a background in M&A, and that's interesting. This is about probably 10th time I've heard that somebody came from a background in M&A, but they went and took some courses on M&A. And I think, correct me if I'm wrong, it's a difference from being on a big corporate team where they systems and process and analysts and all the crazy stuff that a big company does to buy a company than, you and I taking a look at something that's, say, sub $10 million in a valuation. That's a totally different ballpark, a totally different game, right?
It is. I was working with a PLC, and you're absolutely right. It was all around sort of the numbers, and it was a completely different viewpoint. And so when I attended the courses, it was quite an eye opener for me, because all of a sudden it was more about psychology and positioning yourself. And so it was fantastic to learn everything from start to finish and understand actually how it really goes on for the sort of size businesses that you and I look at. I look at typically between 1 and 10 million pounds in revenue.
And then the other eye-opening thing was the psychology, right? You said the psychology was that. I've known it for a long time because in my real estate business, it was that way. Rapport is everything. Every business is a people business and stuff. In previous businesses, I was in the tech industry forever, and in an area where you have like subscribers to your websites and stuff like that, and you never really seen them. So it never clicked that the human psychology came in such a play. I probably would have done better on those startups too, had I played that role and know to meet the psychological needs of the individuals that were customers, right? Not just the technical needs or the logical needs, but also the feel-good psychological needs, right?
It does. And then for the first company that I bought, I tried to find out as much about the individual, the seller of the business, as the business itself. And I remember finding in the local press, close to where the business was located, that this particular seller liked to train dogs. He loved agility handling. That was his real passion. And that was the reason why he was moving out from the business on selling the business so he could focus more and more on that. So I'd found this local paper advertisement or paper report. So during the first conversation, I asked him about that. And it's like, how do you know? Because it's not in his social media as such or not on his LinkedIn. But that helped to build a rapport because it showed him that I'd gone that extra mile to try and find out as much about him and understand him as the
Mhm.
business.
It's interesting is the 2 things is you are who Google says you are. So it may not be in your social media, but if it exists on the internet and you can search it, it's out there. I've asked people some questions before, and I try not to do it too much on the show because it's not really relevant to buying, selling, and growing businesses. So that's what we chat about. But, I've had other little, one-on-ones with people, and I bring up stuff, and like, "Where did you find that?" I was like, Google." Right? And I'm sure
And
somebody does the same thing to me. They'll, like, pull up and go, "Dude, oh, you're the guy to call when your business is too small." I used to have a marketing coaching business, and there's still photos of me plastered around. Much younger, still got a goatee, but the right on it, it says, "The guy to call if your business is too small." That was my slogan, right? So I was a marketing coach. So let's go back to, okay, you're out on your own now. You came from the corporate world. You're out on your own. COVID's happening. You bought your first company. What was that experience like? Was it what you expected?
it wasn't as challenging as I thought it would be because I think before you've done your first deal, you have these preconceived ideas that you're speaking to this seller who was up there with all of this expertise and sector knowledge, and you're wanting to have that conversation and start to build a rapport. And as you progress through the process, and it's just a logical process, you get to the end and you think, that wasn't as bad as I expected it to be. And then the very next thought is, I want to do this again. And that, then you know you've been bitten by the bug and you think, because it was really enjoyable. I was quite fortunate in that the seller was a dream to work with. His information was readily available. He was easy to talk to. We just got on really well from the start. And I think that's what helped. If I'd have come across a seller who was very difficult or challenging in different ways, I may have had a different experience. But I just guess I got lucky for my first deal in that it was just really easy, really, really easy to work with.
I always tell people I only want to work with on a scale from 1 to 10. I want to work from guys who are motivated. So a motivation scale, in my mind, 0 is I wouldn't sell you the company if it's just not for sale, right? I wouldn't sell you the company if you won the lotto and offered me the whole thing. And then the 1 is, hey, you won the lottery, you gonna give me the whole thing. So I'm not interested in those guys that like I'll sell you if you're gonna give me a ridiculous valuation. And right,
Yeah.
the 5 guys are neutral. Like I don't care if I sell it, I don't care if I don't. But it's your 6, 7s, and 8s, maybe even the 9s that interest me because they've got a reason to sell, they've got a reason to complete the process, and on a 10 on my in my mind, a 10 scale is, "I'd pay you to take this," and usually I don't do turnarounds, usually there's something major wrong with those guys, right? We get people
Yeah.
all the time, we're like, they're at that 5 level, how do we move them to a 6?" Like, finding what they truly wanna do next is critical because if they don't have the vision of what they wanna do after this, it's gonna be hard to get them to close.
Yeah, we have that. We've got a certain, well, it's not a script, but it's a list of questions that we want to understand about the seller. And it always comes back to their why and what their plan is afterwards. And usually within that first phone call, in 10, 15 minutes, you're starting to get an indication of what their reasons are and whether or not you'd like to work with them. And sometimes you'll get somebody who's sat back in the chair, their hands are behind their head, and they said, go on, it's almost the body languages will go on, impress me. And you get to the end of that call and think, would I really like to work with them? And if the answer's no, we move on. And if it's somebody we think really enjoyed the call, and we've had this with the business that we're currently looking to close on, we'd had the initial call because they wanted help to prepare for sale. And at the end of that call, we liked them, we liked the business. So we changed and said, actually, we don't want to help you to sell it. We'd like to buy it because we just had this really good report straight off the bat.
Yeah, I get those occasionally. I got one, I think, coming up this week. Sends me a message that says, "Hey, you think you can help me sell a cybersecurity company?" I was like, "I might be wanting to buy a cybersecurity company, so what do you got?" But yeah, it's like, "Yeah, I'll take a look at it." So we're meeting, but he's thinking I'm looking. I always disclose, look, I'm not a licensed broker or anything, but yeah, I have a heck of a network. I've been doing this for a while. I'll take a look at it for you. But I don't think they understand that one of the lenses I'm gonna look through is this something I wanna own, right? I know a few
Yeah.
people in our group, in our circles that have cybersecurity, so it wouldn't even be that I'd have to, take this thing on and be the CEO of it. I bet I could JV with somebody in our circle that has 2 or 3 cybersecurity companies already and plug this into what they're doing and have some equity in it and make sure it's running well.
Well, that's an important thing as well, Ron, isn't it? If you've got a joint venture partner, they bring something to the table that you don't. I'm well aware that I don't know everything. I can't know everything, but I've got joint venture partners who have got those skills that I don't. So between us, we make a good combination, or we think we do.
And you still find gaps when you have JV partners and stuff. You still have find gaps, but then you can bring in a contractor or bring in a fractional person for a little while to help either educate you on those gaps or take over that role or that function. I'm a big fan of Dan Sullivan's book Who Not How. It's probably one of the most life-changing books I've read for me anyway, is I used to any problem I seen, I try to solve it myself. And then once I had a decent solution, I might train one of my people to do it over and over again. But I
Yeah,
try to take on all the problems. So, I was constantly just finding myself, well, how do I learn to read this software code? Because, I need this software code to do X, Y, Z, and I'd be trying to learn how to program something. Or, just one technology or one system or how do I get really good at LinkedIn ads? Like, why am I trying to do that? There are so many people on this planet that are so good at things. Everybody's like, well, you're saving money to do it. It's like, no, you're not. Like the money, the hours it took me to learn it cost me more than the fees that somebody charged me just to do it.
yeah, yeah. I think I gave up long ago trying to understand marketing. It's just not. I've got an appreciation of it, but it's not my thing. So I'll always reach out to the people who can do it.
So that's my thing. I have a master's degree in marketing, and I'm really good at building rapport with financials, right? I'll look if I can read a balance sheet and stuff, but if I look at something and like it's just businesses here, especially here in the United States, they all do things so differently. Everyone you get's gonna look different. Most of the time, I have one or two highlights on a financial sheet. I go, "Why did they put this there? This doesn't look right." I have to take it to somebody you and like, yeah, sometimes it's like you just look at it and go, "That's normal." Sometimes people look at it like, I got to talk to them. I don't know why they did that." Right? But I don't catch them all too, so a lot of times they'll come back and go, "Well, why didn't you highlight this one and this one too? Because that's awkward," for that industry. A lot of times it's awkward for an industry, right? So if they say, they tell you they're running at a 30% profit market and they have a mom and pop grocery store, I mean, not a grocery, but restaurant, in the United States, those things run at, 4 or 5% profit. What's going on here? Right?
Yeah.
What are they doing so uniquely and so much better than everybody else? Or, maybe something's wrong. And sometimes if you don't know the industry well, you might miss that stuff too, right?
Yeah, absolutely. We've seen examples and the analysis that we've done where inventory's been manipulated. The effects is they've increased the stock valuation and it's increased the profitability and it's added to the valuation. So we that's the way that we approach it. Anybody where it's not their thing in financials, we'll go through all the historicals and we'll highlight all those areas where we think we need to start asking questions or understanding what these figures are in the income statements and understanding what the certain areas are within the balance sheet too. Now one of the silliest examples we saw within repairs and renewals in an income statement. We saw this huge spike just before the owners presented the business for sale. And when we dug down a little deeper, it's because the owners had bought themselves an orangery for home and put it as part of repairs and renewals. So we said, well, why? When we understood it, obviously that needs to come out. Of the figures, we need to address or change the figures that were being presented. So we've seen some really wonderful things.
I've also seen a lot of businesses have really long sales cycles, and that's what kills them too. So you have to understand, I think more importantly than profit, more important than a balance sheet and an income statement is understanding their cash flows, right?
Yeah.
So a lot of businesses are cyclical. They have high points in the year and low points in the year, and a lot of them have, different cycles throughout the years. But if you don't understand that off the bat, you could buy something at its peak when the owner already knows it's gonna go down and it's gonna be rough for a year or 2, right?
And it helps, doesn't it? Because you need to be planning the working capital immediately after acquisition. And if all of a sudden it does go into that lull, that quiet period, well,
Mhm.
you may need some additional funding that you hadn't planned for.
What is your process when you're talking to these business owners? You build rapport, right? We already talked about that. But when do you start diving into the numbers and how do you get a business owner to start sharing financials, deep financials?
Well, once if we've had a successful initial meeting, we'd sign non-disclosure agreements and then
Hmm.
request 3 years worth of accounts. Now, we're a little bit more fortunate in the UK that we've got Companies House, so the information is more readily available. But we're looking for the sets of accounts that include the income statements, because then we can start to look at, well, what does the last 3 years look like and the current year's management accounts? We can start to see trends, can dig a little bit deeper around revenue streams, gross margins, and we can look at the overheads, and we can know from 2 points of view. One, we want to see anything that we need more information on. And secondly, it will also show us where there's an opportunity to improve the business post deal. So we'll start to analyze that. Once we've got the accounts analyzed, we've got a history of EBITDA. We'll apply a multiple to that, and we use biz buy sell as a guide for those multiples for whatever particular sector the business is operating in to give us an initial valuation. We'll look at the cash position and decide, well, how is that suffice for what we need? We'll look at any long-term debt and we'll look at any property. That helps us to then look at, well, where do we think the business should be? What do we think the business is valued at? But then we go a stage further and we will look at, well, let's put it together some 5-year forecasts. And we do this very conservatively. So we may assume 5% revenue growth. We may flatline the gross margins. We'll put some basic assumptions in terms of any additional staff that we may require. So it produces the 5-year forecasts. From there, we also know the cash generation for the business. And if we know what the cash generation for the business is, that will start to highlight, well, what sort of deal structure might work. If the owner's wanting to get 60% at completion, that will tell us, well, how do we need to bring any external finance or another investor? Or how can we structure this deal? It could be that 60% just isn't doable for whatever reason. There may be already be some debt on the balance sheet, which will restrict us in anything we can raise. Or it just could be that the cash flow forecast wouldn't work unless the deferment period is over a significantly longer period of time. And it may get to the stage where say, look, love the business, but we can't, this is the best that we can do. We'll leave on good terms, or we'll stop at that point on good terms. And if ever that particular seller wants to come back and revisit it, then we'd love to have a virtual coffee with them or meet them face to face and talk again. But by having that analysis, that future view, at least it enables us to be able to put something together that we know won't put any unnecessary strain on the cash flows of the business.
When you're in that early stage, what are the for us laymen that are not so financially astute as you are, what are some of the big red flags that, like, hey, stop right here. We probably ought to have a more sophisticated financial review of this business, or like, what's the biggest red flag that you would say?
Well,
Call their own Steve Rooms, call their own CFO type.
yeah, I think the first thing we look at is we'll get an initial view on the balance sheet. If it's heavily loaded with debt, there's a red flag. We need to understand that. If we see that the cash balances are dwindling, if we see from the income statements that the owners are taking significant amounts of money out of the business during a time when it's loss making, we've seen this before. We look at gross margins, we look at revenue trends, and straight away, within sort of 10, 15 minutes, we can start to see, well, is this something that we'd like to dig a little bit deeper into because there's some potential here? Or it's going to be too much work, there's too much debt, we can't raise anything, move on.
As far as the debt goes, does the quality of the accounting help when you need to do, like, outside funding and stuff? So if they've got their books in order and everything's perfect, is that better? Or can I guess the real question I'm asking is, can you go into some place that their books are a little bit, they just didn't do them right, and can you recreate those and restructure them and clean them up and get financing? Or do people look at that as bad because you had to fix the underlying company's financials before you applied for loans?
If you have to fix it, or if we need further information, if the accounts just don't seem quite right, then we would go back and ask those additional questions. And if we're satisfied by what we hear, then we're happy to base our analysis on what those findings are. If we're starting to get answers that are a little sort of wishy-washy and we think it doesn't really stack up what they're telling us, then
Mhm.
again, there's a red flag. And it would tend to sort of think, we can't really trust what's been put in front of us. And if we can't do that, then it's pointless moving any further forward. But if we do have those answers and we're satisfied with them, then we'll always put together a suite of documents for potential lenders. So threes of accounts will always create a business plan. We've got the current year management accounts plus the model that I use for all of my deals. We'll present that to the potential lenders, then follow that up with discussions.
Okay. I was curious how it impacted the financial bankability of it, and it sounds like you can actually put together your presentation to the bank and say, this is what it looks like, instead of having to, like, ask the seller, like, "Okay, give me your balance sheet." The bank's gonna some of the financials I've seen, I don't think the financials are bankable, right? Like, you just can't hand that over without doing something to it. And it's not that they're doing right or wrong or good or bad, they just don't know. They've never been trained in it. They only do accounting to the point where they try to stay out of the trouble with their IRS, right? I was on the phone with somebody, I think I said this on the last episode I recorded, but I was on the phone with somebody, and he said, "You wanna see my financials now?" I says, "Cool." He goes, "Where do I send the box?" I said, "Box?" He goes, "Yeah, I'm gonna send you a box of all our invoices and spreadsheets and all." He was literally gonna send me a box of receipts, and I was like, "What do you think why do you think that's the way to do it?" Because "That's what my accountant wants when she does my taxes." And I
Yeah.
was like, "No, I need that stuff put into a spreadsheet or something, right? Like, we gotta do something different." We didn't go any much further than that. It was really small too. But I told him, "So before you call the next guy and tell him you wanna sell your business, you probably wanna find a bookkeeper or talk to your accountants if she has one and construct something that looks like normal accounting and books for people." He just didn't know, right?
Yeah.
Um, he owned a little construction-related business, and, you know, I was interested because it was in a town, where I grew up, and I knew people there in that space that I could have run it. So
Yeah. And I think that's another key point though, isn't it, as well, Ron? Because people take a decision to sell their business, but they haven't taken the time to prepare it. And so have we got all of our systems and processes put in order? Have we got our accounts that are in good shape? And then they expect somebody to come along and just give them whatever price they want. They always want the magic million. Of course, they're not going to get that because anybody coming into the business, they've got so much to do. They've got to put the systems and processes in. They've got to sort out the accounting or the reporting side of things. So there's so many things that they can do beforehand if only they took the time.
and it's a case of they don't know what they don't know. They've never Googled or out how do I sell my business and figure out there's, 38 steps, or I'm making a random number up. But there's so many steps and, 1 to 3 year process, right? To make it ready to sell and maximize your value. They don't know what they don't know. I've had some business owners, like, almost flat called me a liar on the phone. "That's not how this works." Like, "Yeah, it is. There's some work you need to do. You're not, I'll take a look at it, but you're not gonna get what you want from me because I'm gonna have to do a lot of the work that most sellers that come to me would have already done." Right?
Yeah,
And, quite honestly, your business would be I told the guy, I said, "Your business would be so much worth so much more when I'm done doing what you need to do that, from what I bought it today, it would be worth it for me to take it over from you, do all the spend the 2 to 3 years it really needs to diversify your customer holdings, make better books and clean things up, and then turn around and sell it. I'd make a heck of a profit. Or you could do that yourself because you're not gonna get anywhere near you want number you want." And, business owners, sometimes they get a little offended by that, and when you're the first guy that tells them to that, you're the bad guy. And after the
yeah,
second or third or fourth guy that tells them that, they go, "Oh, yeah, I probably ought to go do this."
yeah.
Or they finally called that broker, the broker's like, "Yeah, we gotta clean this up."
And I think sometimes you also come to the conversation with preconceived ideas. They've spoken with their accountants or CPA, they've spoken with a business broker, and they've got this inflated level of valuation. And so we use tools. There's one in particular that we use called Vonatua, where it's an independent piece of software, a questionnaire. We ask them, "Well, look, would you please just complete this?" And it's asking them a range of questions around how they operate the business, the key financials. and you will give them a report that says, well, based on what you've told us, the business is currently worth this. But if you were to do X, Y, and Z, your business valuation will go up to, and it might get closer to what their expectations are. And then it almost breaks down that preconceived idea. And it gives them a sense of reality. So we will often use that where we're speaking with a seller that's got this weird and wonderful idea that they're going to get $3 million and then go and buy a yacht and sail off into the sunset. It's just not going to work like that, as you say.
Yeah, I usually I don't bring up numbers in the first couple calls. I just try to build rapport. Occasionally they will, like, they'll come up and somebody will say, "Well, don't you want to know what I want for my business?" Like, "Sure, tell me what you want for your business." $2.5 million. Oh, cool. How did you come up with that? Well, I talked to my CPA and he told me that's what I needed for, or I talked to my financial advisor and he said that's what I needed to fill out my rest of my retirement plan after taxes. I was like, "Okay, cool. Let's just see how we can get you there." And I just leave it right there because I know, like, how we can get them there a lot. At the end of the conversation after we finish the rapport building, I do see some of the numbers. A lot of times the how we get you there is like, "Look, in order to get there, you're gonna have to get your revenue up to this, your profit margin or your profit margin up to that. So at your current profit margin, your revenue has to be X. Or you can improve the profit margin. What we really need to do is get your seller's discretionary earnings or what they call EBITDA to a certain level for you to hit that number, and you're a
Yeah.
third of the way there, right? How would you like to proceed?" And they're like, "Well, I didn't I wanna sell it." I'm like, "Well, no, you just told me you needed 2.5 million, and I just shared with you to get that, you've got 2 to 3 years worth of work ahead of you. So what do you want us to be what do you want the next step to be?" And I let them figure it out, like, "Well, I need to work with somebody to figure this out." Or, like, "Let me go talk to them because I guess we're gonna sell it for less," right? You have to let them to see that there's something, but I have not had great luck being the first guy to tell a business owner their valuation is way off. Usually, sometimes I've had them come back and talk to me again later, but, usually that call doesn't end that great, and they go back and try to find, like, somebody else, and it takes 2 to 3 people telling them the same thing before they're willing to sell it at either what it's worth or willing to do the work to make it
Yeah,
worth more. Yeah.
yeah, absolutely.
So, what is I know you've done all kinds of stuff. I've seen some of the stuff you put out there for financial models and stuff like that. What is the best way to kinda get started? Is there a way or a resource or a tool that people can use to understand finances better, to get a leg up on what they should be looking for inside of the paperwork that's sent back to them?
Well, there are courses out there. People can do their own research. There's various resources online.
Mhm.
We can help them. We can support them. If anybody wants that sort of support, we've got a model which they can have with pleasure. If there's something we can do. We've done it. We've got a done for you service as well, where we will take them through. At the current time, we're just preparing some ebooks for anybody just wanting to get started. That's probably one of the best ways, where we'll
Mhm.
take them through what each individual statement is within a set of accounts. We'll explain the income statement and the balance sheet and various terms that will often crop up when analysing deals. So we've got a series of 3 books that we're just preparing now for people, and that hopefully will help.
And then when you guys work with people, is it on equity or is it a consulting fee or is it a combination of both or how is that structured?
We've got it's typically it's on a fee, so we'll work for people on a fee basis because they're other deal makers,
Mhm.
so they want to go off and do the deals for themselves. So we'll support them. We will work with other people for equity. That's more external. If it's a deal that we're happy or we're keen to look at the business and help them, support them with a view to eventually owning it, then we'll look at. I call it a whiteboard structure or a consulting for equity type arrangement, but typically with other deal makers and they will. It's just a fee. They'll once they've got that service, we'll provide them with the reports and the analysis, and then they will. Then we can put the follow up call with them. We'll make sure that they're as well prepared for the follow up calls with the sellers as they can be. We're always there in the background to jump on another call if they need us.
If I'm a business owner and I bring and we have our initial first conversation, how does it go for you? How do you evaluate a business? I know you already talked about building rapport, you talked about getting the numbers. Is there a step-by-step process? You seem very logical, so and a lot of the CFO and financial people I know, they've got procedures to everything, right? This is the way we do it. Do you have a step-by-step process you put? put businesses through, even if you don't display it to them, that either mentally or on paper you check off a certain list of things in order you do?
We do. So prior to any first conversation, we've done some commercial due diligence. We'll have a mystery shopper. We'll often contact the company. How quickly do they respond? Maybe ask them for a quote for a particular service. We'll do the due diligence around the owner. I'll try to find out as much about the owner as we can up until that first call. So then when we actually have the first call, we can talk about it. It's not just about the numbers. It's about the business itself. We look at online reviews. What does that look like? The Google reviews. We'll look at the website and the social media presence. So there's a lot of things that we do prior to the first call. Once we've had the first call, it's all about how do I like this guy? I'll have made a decision that I like that. I've got an interest in the company. Do I like this particular person who's selling the business? If we can build rapport during that first call, great. Then we can move on to a next step where we're looking to do the analysis and move on from there. Have follow-up calls. We will often, if we get to the stage where we think we're pretty close on valuation, it may not be quite there. I'll certainly be looking to go down onto and meet face to face at the premises after hours, because often, as you know, sellers are quite reluctant to have anybody on site who's looking to buy the business. They don't want to upset the staff or spook them in any way. So yes, there's a logical process to everything that we do. We use Kanban boards, so we've got it all set up for various stages of the acquisition process. We move people through that process.
Yeah, I actually walked through a factory once, and I wasn't even thinking what I was doing. I was dressed up to go to an event later in the day, which was kind of a wine and networking event, but it was kind of a higher end one. So I'm wearing my higher end nice cowboy boots, and I'm dressed up pretty well. And he had me come tour his factory. He'd already told his employees that I was an insurance rep. And the floor manager goes when he introduced me, they took me out on the floor to look at the factory, and one of the floor manager looks me up and down, he says, "What kind of insurance rep wears $800 boots?" And I was like, "I've got an event to go." I just told the guy, "So I've got something I'm going to when we get done here, so I'm a little more dressed up than I need to be." And,
Yeah.
so he goes, "You must be doing pretty good at insurance." And I was thinking, I should have never wore my alligator boots because, like, I was going somewhere, I was dressed up to the T, and I was thinking, it's important that a lot of times you don't know if you go do a site tour of these businesses, a lot of times you don't know what the owner told them if it's not after hours. They usually tell them you're an insurance guy or a potential employee. If they tell them anything, they tell them something that's not true, and they tell you the story, and you get up, "Hey, man, if anybody asks you, you're an insurance rep."
But I think mirroring is pretty important though, as well, isn't it? If I'm speaking to a business that's in engineering,
Mhm.
I'll be conscious. I'll be looking at what they're wearing, and I'll dress down or I'll dress something that's more appropriate. If I'm speaking to a firm of accountants or CPAs, I may have a suit on, not necessarily with a tie, but I'll just dress more appropriately, and I'm trying to mirror how I think they'll present themselves.
I'm trying to think here. We'll go back to the financing stuff. I know it's probably a little more standardized where you're at just because you have Companies House, people have to report their stuff. Have you done many evaluation? What's the difference I know you have, when you look at US-based companies or companies that don't have Companies House and don't have government reporting they have to do, is it drastically different than what you I guess I'm trying to clarify my, assumption that books are just cleaner over there because of Company House. Is that true or false? And what's the difference you see?
Yeah, they can be a little cleaner with Companies House because they've got there's more criteria that we need to meet in order to be able to submit. The work that we do for US-based clients, we look at the tax returns for the particular businesses, but we'll always try and get hold of the management accounts, whether they're using Xero or QuickBooks or whatever their accounting software is. We want to see that as well, because we have seen examples where the management accounts bear no relation to the tax returns. And again, it's a red flag, but certainly we need to understand what that is. We've had clients this week where there was a significant difference between what the zero books were telling us and what the tax returns were. So we've had to go back to the seller and dig a lot deeper.
Do you go back to, like, having, like, "Can you give me a printout from all your or log into all your bank accounts so I actually can rectify tax return versus Zero or QuickBooks? What's what actually in the bank?" You actually do the rectification and verify that way?
Well, initially, we will be asking the questions of the seller and wanted to get that more in-depth explanation because we're conscious that we wouldn't necessarily go into a more granular detail at this stage until we'd got a letter of intent signed or heads
Yeah,
of terms, as we call it. And then we're getting to the due diligence. And at that point, we're really wanting to get under the hood and look at the line detail.
yeah. What's the time frame to do that, though? I mean, I always look at that as a very lengthy time frame, and a lot of deals we do where it's joint venture and stuff like that, you relax a little bit on the due diligence up front because you know that, you don't have a lot of money invested, you got time invested, and it's more of a joint venture thing. You're gonna learn that stuff over time, but if anytime you gotta take a bank loan or put personal guarantees down or put significant input, I would suggest we all do full due diligence, and at that time frame, is it usually can you get it done in 60 days, or is it 90 days to really take a look at, tax returns versus 0 QuickBooks versus the actual all the actual physical bank accounts to make sure that they're in agreement?
Well, we'd typically work on between anything between 1 and 3 weeks to actually put the data room together of
Mhm.
because we've got a standard due diligence questionnaire, and we'll ask the sellers to complete our data room, populate it with that, and then we'll spend about another week going through that information. If we need to go into the quality of earnings side of things, we'll do that. If we need to get additional information such as bank statements, again, we'll request those. But that's part of our initial due diligence questionnaire anyway. So it's within a month, typically in the UK, we've got everything that we need in order to make an assessment. And during that time, obviously, we're preparing sale and purchase agreements and consultancy agreements. So at least we can be getting on with other things whilst the sellers are preparing the data room for us.
Now, do you do QTAs or do you outsource those quality of earnings reports?
We can do them. I know that we've got there's other guys in the US who we can go to as well if the owners or I beg your pardon the investors are looking for somebody local, then we've got people we can put them in touch with, but we can provide that service too. The principles are the same. We just really need to get into the detail and understand what's going on.
And as far as bankability, does that make it more bankable? Are banks happier to see a quality of earnings report than a set of books, or does that
It,
carry any?
it's It certainly helps, and we've had people who've requested quality of earnings reports. We've had an example recently with an e-commerce business. I mentioned the one earlier where they'd gone they'd increased significantly in the latest set of accounts. So the potential providers of finance insisted that that's one of their criteria was to have a quality of earnings report done.
And what do you see the cost of those? Because I know you can do one, and I know the outsourced ones. I've had a couple guys on the show that's all they do. They do quality of earnings reports. I know what they charge and stuff, but based off your normal, sub $10 million a year revenue business, what does a quality of earnings report cost to get done?
We've seen it between $15,000 and $35,000 for
Yeah.
those sorts of reports.
I was gonna say the people I've had on the show has always been between, some of them dip as the little companies, they'll dip down to 10K, but it's somewhere between that and 30,000, right?
Yeah.
So, you can kinda count on 12.5K to 15K or up. Okay. Um, what are some of the other things that people should look for? We talked about, the initial red flags there, but are there any little things inside of finances that are kind of maybe not glaring red flags, but something you see commonly that people need to be aware of, and that they need external help if they see these things?
One area that we see is we look at the repairs and maintenance costs. So, for
Hmm.
example, if we start to see that increasing or it's of a significant level, we would always look at that in conjunction with the fixed assets register. And straight away, we can start to see, well, how old are the assets that they've currently got, whether it's a motor fleet, whether it's some of their plants and machinery. And then we can start to assess, well, how soon after completion do we potentially need to replace these assets because we need to factor this in to our cash flow forecasting. So there's one particular example where we'd give that some scrutiny.
It's interesting is one of the groups I'm working with, they acquired a company in Australia, and within the first month, they had their employees goes, "Hey, this big piece of machinery and that piece of big machinery over there, it doesn't work. We need to replace them." Right? Luckily, they made it happen and they got it done. but it was kind of an eye opener because it was never brought up through the whole process that they had machines that were, band-aided together and barely functioning to keep it going, and the employees were really adamant that it was not working well, maybe even unsafe.
And there's others areas too. For example, we'd start to look at age receivables days or debtor days, as we call them here, and creditor days, stock 10 days. Oh, if we start to see it increase, well, what does that tell us? Are they not as efficient at collecting the debt as they were previously, or does it indicate there's some bad debt building up? So again, if we can see an age receivables report that's been aged, we can then start to take a view, because that may be important as well for financing. If we're looking to raise finance off the debtor book, we know that they will apply certain criteria. So some of the oldest debt would be discounted. So we need to understand that. So again, we would always ask the sellers to provide a fixed assets report and an aged debtors and receivables report as well. Payables and receivables, I beg your pardon.
We seen one that was in the construction space. We were all the way into the due diligence phase of this. It was a small group of people I was helping out, and what we noticed, what I noticed actually, before I handed it over to that's when I insisted upon handing it over to a CPA type, was you would see the accounts receivable, and it would age up to about 180 days. You'd see it drop off, like, "Okay, well, cool, they paid." I would go try to look at the income statements and the balance, and some of these were significant invoices, and I was like, "Okay, I'm looking to see where it went," right? Because I could see that, because I was concerned they had a lot of accounts, big accounts that were aging out, like, were, getting long terms. They were bad at collecting their money, and, I finally just came out and asked the owner, I said, "What's going on here? I see, this account was 180 days due in June, but I can't see anything at the end of June or July or anything where the money got paid. Where did it go?" Right? I don't see that bump in any of your other financials. "Oh, if they don't pay in 180 days, we just quit doing business with them." I think, "Don't you go after that money? That's $127,000. He goes, "Yeah, they still owe it to us, but until they pay us, we're just not gonna do any business with them." "So you just take them off the accounts receivable?" He's like, "Yeah, I don't wanna look at it anymore." I was like, "That's not how that
Wow.
works." He's doing him and his team were doing their, like, "I just don't wanna stare at the bad news all day." And I was like,
Yep.
"That's not how that works. What is your real accounts receivable?" So I started going back and added that they were owed considerable amounts of money, and it was almost worth taking on, like, "Look, I'm really good at negotiations. I'm really not afraid to call people." I was like, "How much of that
I'm,
accounts receivable would you give me if I collected it?" He said, "What do you mean?" It's like, "If I called every single one of those companies that owed you money and I got you something from them, maybe not the full amount, but if I got you something from 'em, how much of it would you give it to me?" He goes, "I'd have to think about that." He never let me do it, but I think I could have made some good money if he'd have given me a big chunk of that because I don't think they asked. I think they just
yeah.
got frustrated with him because they hadn't paid and, told him to, "You can come back and we'll help you again when you pay us." And there's enough competitors in town, maybe they won't, right?
Yeah, because in that respect, it's also presents an opportunity as well, doesn't it? If you're seeing age receivables days that are 120, but you know that you've got a team who are really efficient at collecting cash, well, straight after acquisition, you can drive that down to 60 days. Well, that brings cash into the business, doesn't it? And it gives you that additional working capital that supports whatever your growth campaigns are, or growth opportunities are.
And if you know the industry well enough to know that, like, this was construction industry, the construction industry is rife with that type of stuff. For people who will not pay you, not do the work, not giving you your money. It's. I owned at a real estate investment firm for a long time. Contractors can be bad. You start to
Yeah,
learn a vetting process of who you do the work for before you do it too. So a lot of
yeah,
times, a lot of those were
yeah,
probably just bad debt. Right, but what the owner didn't realize is there's also a lot of mechanical liens and other stuff that can be done in that construction space that's not available otherwise, you know? You go slapping mechanical liens on people's houses, they might pay you back something. So, but, I
yeah.
was willing to
Um,
do the work, and he just wasn't. He just It's like, "It's not worth the hassle." I was like, "Yeah, I think you're owed probably." I did the math off the top of my head. I think you're owed 2.5, $3 million over the last, 6 years.
wow.
Right? And I'll have to look at your state and see what the statute of limitations is, if there is a statute of limitations of going after these people and collecting on it. But, yeah, because some states you can only file like that mechanics lien or something for so long after the job was done. But, some of them, I think it might be a couple years. So, but yeah, what are the other is there anything else inside of the financials? Like, okay, do you have
Yeah.
a financial model or a forecasting model where you can look at somebody's past and kinda look at what's going on in the market and forecast what you can do with it? Or is there a spreadsheet or model you can plug things into?
Yeah, we've got a spreadsheet model that we use, which has evolved over time. We've used this with over 150 clients now, and as people have used it or seen the model results, they've said, "Well, wouldn't it be good if it could do this?" So over time, as we've got feedback from various clients, then we've changed it and updated it so that it will look at all the historical, it'll look at the future forecast, it will look at valuations and deal structures, as well as also we provide a set of suggested offers. We could even put something like that in there as a guide. So that's the model that we use. When that's available, people can come to us and we can provide that to them, or we can do the number crunching for them.
What's your favorite industry? What I mean, you bought a few companies right now. Are you buying financial companies, or are you all over the place in the market, or what is your acquisition criteria?
Well, we're putting together a group of accounting businesses here in the UK. So we're looking to put together between 6 and 10 over the next 3 years, 3 to 5 years. I've got other joint venture partners, one of which is in the leisure sector, which is a walking holiday business where we know that most of the clients are coming in from the US and Canada because they'd love to come over to the UK. So we're really interested in that one. This is the one where they originally approached us because they wanted help to sell. We
Mhm.
spoke to them and loved it. I thought, well, actually, we'd like to make an offer to buy it. So we're just about to close on that one. Well, we're looking to bolt onto that a castle business where people can stay in castles and cycling. And there's all sorts of things that we'd like to do with it and put a group together around that. Precious metal is another one. So that's early stages. And we've also got one in recruitment. But again, that's early stages. So we've got 4 verticals at the moment. But again, each one of those is with a joint venture partner. It's not something I do on my own. And I want to work with somebody where they've got the skills that I don't have.
Is there a buy box as far as revenue size, location, number of employees, number of like, or I call it account dependency or anything like that?
Yeah, well, so we're looking at UK-based companies with a minimum turnover of 1 million,
Mhm.
because if we've got £1 million worth of turnover, it's more likely to have a management team. We'd
Right.
like there to be a management team in place, or if there isn't, we'd like to identify somebody in the business who could step up into a more senior role because we don't want to buy ourselves a job. We want to be able to focus on growing the strategy side and growing that group. So we'd always look at that with a minimum age of around 10 years. So we've got a bit of maturity about them. And as a guide, we look at revenue per head. And we're looking for a minimum of, typically it's £100,000, but in accountancy in the UK, it's less. It can be anything between 55 and 65.
Hmm.
But that's sometimes an indicator as well of the lack of efficiency. So if we can come into that business and look at some of the software solutions that help us to improve efficiency, we're looking to then nudge that back up to in excess of £65,000 per head.
I'm gonna ask you a question. I don't know if you're even in this space or not, but I'm curious. How is AI impacting what you do now? And have you looked at that much? Are you messing with any of the is AI starting to do anything in the accounting space?
It is. So we're starting to see if we take an example of Zero, that's got AI built into it, or a level of AI. There are tools which work with Zero. There's one called Dex. There's another one called HubDoc, which Zero acquired, and that's got it into artificial intelligence, so it can actually read the invoices which are sent via email. It can read it, populate it, and then put it into Zero for you, along with a PDF of the invoice itself. So we're starting to see more and more, to the point now where if you're going to, I've got a big belief that if you're going to add value as a CPR or as an accountant, it's not on the transactional side. It's not what we call compliance. It's helping those business owners to get from $1 million in turnover in revenue to 3 million. It's about looking at the future and working with them to help them to get from A to B, and putting that accountability and that structure in place to help them to do that. That to me, that's where you add the value. It's all very well as we can tell you, yes, well, last year you made this amount of profit, and here's the tax bill. Thanks very much. That doesn't help them to meet their aspirations.
Awesome, awesome. Well, how do people reach out to you? If somebody wants to work with you, have an evaluation done of their business, have you do something for them? What's the best way to reach out?
They can reach me on LinkedIn. So I'm available on LinkedIn. They can reach me at info at profix.uk or steve@steverooms.com is another email address that I've got. So any one of those ways that they can reach me.
I'll put all that in the show notes too. And then the last question I always love to ask is if somebody can only think of or remember, say, 2 or 3 things from today's show, what would you want them to have as takeaways from learning from Steve Rooms?
I think one of the things that I'd say is when you're looking at buying a deal, you don't try and, or buying a business, don't try and do everything yourself. Surround yourself with the people who have got that knowledge. So if you don't have the financial knowledge, it's not the end of the world. Go and find somebody who can support you with it. There's some very good accountants and CPAs out there. We can certainly support the people with that. So don't think you have to do everything by yourself, because you don't.
Awesome. Well, thank you for being here today. I think we'll wrap it up and call that a show and hang out for a few minutes.
Thanks very much. Thanks for inviting me.
I want to announce our new channel partners, the ITX Marketplace. Since 1998, ITX has created $5 billion in value by selling more than 225 IT businesses in 20 countries. ITX works exclusively with IT-enabled businesses generating between 5 million and 30 million who are ready to be sold, and M&A decision makers who are ready to buy. For over 25 years, ITX has developed industry knowledge that helps determine whether a seller is a good fit for their buyers before making the match. ITX Mergers and Acquisition Marketplace we have partnered with has a proprietary database of 50,000 plus global buyers seeking IT service firms, managed service providers, Microsoft service providers, software as a service platforms, and channel partners with Microsoft, Oracle, ServiceNow, and the Salesforce space. If you have an IT-enabled business you're ready to sell, I want you to visit the itexchangenet.com/marketplace. How to exit. That link will be in the show notes. Visit them now.